Well, intuitively, we all know that investors tend to buy at the highs and sell at the lows. And after 21 years of research, Dalbar, the US research house, confirms that that's in fact true. The greatest ever collective buying of mutual funds was just before the peak of the tech wreck, the March 2000, and the largest ever quantum of selling of mutual funds was at the very bottom in 2009 of the GFC. Now, presumably it would have been worse had it gone on for another month, but the point is that investors tend to buy at the highs and tend to sell at the lows. The result of that behaviour is that they do worse than even the funds they invest in. The most important thing to remember is something we talk about at Montgomery all the time, is you're buying businesses, not trading stocks. And if you have that idea in mind or as part of your framework, then you realise that it's just going to take years for a business to increase its value. So it has to generate profits, it has to retain those profits, and it has to reinvest those profits. That's a process that takes time. But of course, the stock market is incredibly impatient, and so people tend to take their cues from prices. If prices are falling, the business must be bad. If prices are rising, the business must be good. When often, not always of course, but often it's the opposite. Well, the most important thing that we do consistently is we have a valuation for each company. So we already know which companies are quality companies, those with bright prospects, those with great economics. We have a valuation for that. Without that valuation, it's more likely we would react to prices. But because we've got a valuation, we can see price movement for what it is. So we can see when there's an overreaction on the upside and on the downside. When prices go well above what we think the long run value of the business is, that's an opportunity for us to sell. And when prices fall well below what we think the value of the business is, that's an opportunity for us to buy. And in the quality space in the market, we've seen that in late 2016. Sure. Well, let's take a couple of businesses. Let's look at Healthscope, for example. Healthscope's a business where it runs 45 private hospitals in Australia. It's about to build another one, a very large one, in Frenchs Forest or Forestville, at about 400 beds. The prospects for that business over the next 5, 10, 15 or 20 years is extraordinary. The greatest contributor to admissions in private hospitals is the 64 to 75-year-old cohort and the 85 plus cohort. They also happen to be the fastest growing demographic cohorts in Australia. So that trend is not going away anytime soon. If you look at the trend of admissions and surgical procedures in Australia, you find that over the last 20 years, it's growing at a faster rate. If you look at the last quarter or the last 3 or 4 quarters, you'll see that there's variability in those numbers, and that's what Healthscope experienced in the September quarter. The company came out and mentioned that it was more volatile than usual. Shares sold off by about 30% in just a couple of days. So you can sell at the lows, or you can see that as an opportunity to buy, and we saw it as an opportunity to buy. There are other businesses as well where the same thing has happened, and one of them we think is a business called Vita Group, run by Maxine Horn, 103 Telstra stores around Australia, arguably some of the best retail management skills, techniques and processes that we've ever seen in any business. And a change to remuneration saw investors just say, look, get me out. Remuneration from Telstra. That business, we think, run by Maxine and her team, will ensure that any holes that occurred will be filled and some. So again, a share price that fell significantly. Final one, REA Group. We know its long run prospects are extraordinary. We know it's going to make more money in a mature property market or a declining property market. We know it'll do very, very well, and yet share price down 30-35%.